Len Martinez, PhD CPA, is president of Bull Valley Advisors. Len publishes the Bull Valley Advisor, a stock market newsletter for institutional investors, featuring his BVA Value Momentum portfolio strategy. Podcast, anchor.fm/Len-Martinez-PhD-CPA. Institutional investors visit my website to subscribe and ask for a free copy of the Bull Valley Advisor monthly email newsletter. www.bullvalleyadvisors.com. Investing in value stocks with positive price momentum. March 23, 2020 Market Commentary. March 24, 2021. Wall Street closed deeply in the red on Tuesday, as Fed Jerome Powell chairman said the economic recovery still has a long way to go. Federal Reserve Chair Jerome Powell and Treasury Secretary Janet Yellen repeated that the American economy is recovering from the coronavirus at a hearing before House lawmakers, but that some sectors remain weak. Meanwhile, the 10-year Treasury continued to decline and settle near 1.62%, while oil prices plunged more than 6% amid the threat of a third wave of global infections. The Dow Jones shed 308 points, or 0.9%, to 32,423. The S&P 500 retreated 30 points, or 0.8%, to 3911. The Nasdaq declined 150 points, or 1.1%, to 13,228. The dollar index regained ground on Tuesday, touching a two-week high of 92.30 as a shift in risk appetite has favored safe haven flows, while the overall outperformance of the U.S. economy relative to the rest of the world supercharged this buying momentum. In the broader scenario, the combination of ultra-easy monetary policy, unprecedented government spending, and a successful vaccine rollout prompted investors to bet on a swifter U.S. economic recovery and inflation pressures. Federal Reserve Chair Jerome Powell and Treasury Secretary Janet Yellen repeated again that the American economy is recovering from the coronavirus at a hearing before House lawmakers. The most pronounced buying activity was against risk-sensitive currencies, such as the Australian and New Zealand dollars, both hitting multi-month lows against the greenback. The yield on the benchmark 10-year Treasury note fell for the second day to 1.65% on Tuesday, the lowest on a closing basis in nearly a week, and below 14-month highs of 1.75% reached in the previous week. Investors await several Treasury auctions during the week to see if demand remains strong. The offerings include a 7-year note, a 5-year note, a 2-year note, and a 52-week bill. A $38 billion sale of benchmark 10-year notes earlier this month drew solid international demand. Yields have been rising since August, but gained speed from mid-January as coronavirus vaccination and further fiscal stimulus support prospects of a strong economic recovery, but can lead to a spike in inflation and debt levels. Still, the Federal Reserve has been reiterating any spike in inflation is likely to be temporary, and pledged to continue the ultra-easy policy for some more time. Fed Chair Powell reiterated the Fed is committed to using the full range of tools to support the economy, and to help assure that the recovery will be as robust as possible. Prepared remarks to his testimony on the CARES Act before Congress showed. The recovery has progressed more quickly than generally expected, and looks to be strengthening in part due to the unprecedented fiscal and monetary policy actions. Meanwhile, Treasury Secretary Yellen, who will also testify, noted that while there are signs of recovery, the country is still down nearly 10 million jobs from its pre-pandemic peak. The euro traded lower around $1.188 on Tuesday amid a general dollar strength, as an uncertain coronavirus outlook, extended lockdown in Germany, and tensions with China over sanctions weighed on investors' risk appetite. Meanwhile, bond yields fell across the region while recent data showed the ECB bought €28 billion worth of bonds last week, a 48% increase over the previous week, and the biggest weekly amount since December 4. During its March monetary policy meeting, the ECB said it would conduct emergency bond purchases at a significantly higher pace over the next quarter, aiming to bring government bond yields down and to support the Eurozone economic recovery. U.S. current account gap widened by $7.6 billion to $188.5 billion in Q4 2020, which is equivalent to 3.5% of the GDP. It is the biggest current account gap since Q2 2007, as the goods deficit widened and the services surplus declined. The goods deficit increased to $253 billion from $248 billion in Q3, led by imports of industrial supplies and materials, automotive vehicles, parts and engines, and consumer goods. Meanwhile, the services surplus shrank to $53 billion from $56 billion in Q3 as purchases of personal travel and sea freight transport grew. In contrast, the secondary income deficit narrowed, negative $36 billion versus minus $38 billion, reflecting a decrease in private transfers, mostly fines and penalties, that was partly offset by an increase in general government transfers, primary taxes on income and wealth. Considering full 2020, the current account deficit increased sharply to $647 billion from $480 billion, the highest since 2008 and equivalent to 3.1% of the GDP. Stocks of crude oil in the United States increased by 2.927 million barrels in the week ended March 19, 2021, after a 1.047 million fall in the previous week and compared with market expectations of a 0.9 million decline, data from the American Petroleum Institute showed. Oil prices plunged more than 6% on Tuesday, with WTI crude falling below the $58 a barrel level for the first time in over a month amid a stronger dollar and concerns about a recovery in fuel demand as lockdown measures worsened across Europe. Germany extended its lockdown until April 18, and France and Poland announced new restrictions measures. Adding to the bearish tone was the announcement of Western sanctions against China, the world's largest oil importer, over human rights abuses in Xinjiang, with Beijing immediately launching retaliation against Europe. Sales of new U.S. single-family homes sank 18.2% to a seasonally adjusted annual rate of 775,000 in February of 2021, following an upwardly revised 948,000 in January, and well below market forecasts of 875,000. It is the lowest reading in 9 months amid adverse weather conditions during the month. In February, new home sales plunged 37.5% to 85,000 in the Midwest, 16.4% to 194,000 in the West, 14.7% to 458,000 in the South, and 11.6% in the Northeast. The median sales price increased to $349,400 from $331,800 a year earlier. Gold struggled to gain traction on Tuesday and remained stuck near the $1,730 per ounce region, as investors appeared quite reluctant to open new positions after Federal Reserve Jerome Powell refrained from expressing any concern about the recent pickup in Treasury yields. Investors began pricing in a robust economic recovery and rising inflation fueled by the vaccine's rollout and unprecedented government spending. In the absence of significant fundamental drivers, the current market environment has benefited the USD, making it more difficult for the precious metal to attract investors. Silver extended losses to a 2-week low of $25.50 an ounce on Tuesday, as a stronger dollar drove flows away from the metal. Putting a floor under prices was some safe haven buying stemming from surging coronavirus cases across Europe. LME nickel futures consolidated around the $16,200 per ton level in late March, as investors remained cautious amid persistently weak demand in the spot market. Sentiment continued to be dominated by oversupply concerns after China's Tsingshan Holding Group said it would provide domestic markets with an extra 100,000 tons of nickel matte. Still, the commodity growing usage in lithium-ion batteries and the accelerated rollout of electric vehicles should drive prices higher in the long run. Prices for iron ore cargoes with a 63.5% iron content for delivery into Tianjin were trading around $156 a ton, a level not seen since February, amid a deteriorating demand outlook as investors anticipate the chance of further production cuts in Tangshan. China's top steel-producing city has pledged to cut emissions by 50% during heavy pollution days and punish those who fail to implement output restrictions. Putting a floor under prices were persistent doubts about Brazilian shipments and prospects for a robust global economic recovery. rubber market has been struggling to find momentum in March, with futures on the Tokyo Commodity Exchange trading around the 260 yen per kg region for the first time in a month. In the absence of significant fundamental drivers, investors have been quite reluctant to open new positions, but physical demand and wintering have capped much of the downward pressure. In the broader scenario, rubber futures also got punished by falling crude oil prices and some profit-taking on other commodities. Chicago lumber futures were trading around $930 per thousand board in March, buoyed by robust real estate markets and expectations of a swifter economic rebound fueled by massive government spending and vaccine rollouts. While the stay-at-home lifestyle has encouraged homeowners to expand or remodel their existing dwellings, low mortgage rates exacerbated this home-building spree. Given the above and the fact that supply remains quite scarce, with purchasers struggling to fulfill existing and new buying requirements, prices have room for further upside momentum. The Baltic Dry Index fell 2.1% to 2,271 on Tuesday, snapping a six-session winning streak on weaker demand across all vessel segments. The Capesize Index, which tracks iron ore and coal cargoes, declined 3.2% to 2,305, and the Panamax Index, which measures coal or grain cargoes, was down 2.5% to 2,983, halting a seven-session rally. Among smaller vessels, the Supramax Index dropped 7 points to 2,126. European stock markets pared some losses to close little changed on Tuesday, as investors digest rising COVID-19 cases and new lockdowns across the region while tensions with China weighed on sentiment. Germany extended its lockdown measures until April 18 and postponed reopening plans to try to defuse the third wave of infections as intensive care beds are filling up again. Meanwhile, the U.S. National Institute of Allergy and Infectious Diseases questioned AstraZeneca COVID-19 vaccine trial data, a day after results from an American trial were released. Finally, the EU, the US, the UK and Canada imposed sanctions on Chinese officials for human rights abuses in Xinjiang. Frankfurt's DAX 30 edged up and Madrid's IBEX 35 gained more than 0.5% driven by a rally in Bank Inter shares, while the London's FTSE 100, Paris CAC 40 and Milan's FTSE MIB closed lower. Brazil's Ibovespa lost 17 points or 1.5% to 113,262 on Tuesday to extend the previous session's sharp decline, as a new wave of coronavirus contagions threatens to derail the economic recovery. Hundreds of Brazilian economists, including former finance ministers and central bank presidents, urged the Brazilian government in an open letter to speed up vaccination and adopt tougher restrictions. On Monday, President Jair Bolsonaro reportedly asked the country's Supreme Court to reverse coronavirus restrictions imposed by several federal states. On the data front, the FGV Consumer Confidence Index in Brazil fell sharply in March to its lowest level since May, as the recovery cools down sharply. Canada's main stock index fell for the second session in a row on Tuesday, with the benchmark S&P/TSX Composite ending below the 18,700 level for the first time in 2 weeks, as weakness in commodity prices fueled a sell-off in shares of the heavyweight energy and resource sectors. Market sentiment deteriorated in the light of rising coronavirus cases and a sluggish vaccination campaign in Europe, which have prolonged lockdowns and delayed expectations of a global economic rebound. Westport Fuel Systems Inc. and MEG Energy Corp. were among the biggest laggards on the TSX, down 10.4% and 8.9%, respectively. The FTSE 100 retreated 27 points, or 0.4% to 6,699 on Tuesday, down from a 0.3% gain in the previous session as tensions with Brussels mounted as the EU is considering restricting exports of COVID vaccines across the English Channel. The U.S. National Institute of Allergy and Infectious Diseases questioned AstraZeneca COVID-19 vaccine trial data, a day after results from an American trial of the AstraZeneca/Oxford vaccine were released on Monday. Travel and airline stocks remained under pressure as the country tightens border control with travel fines of £5,000 for Britons who try to travel abroad before the end of June. Concerns over infections and lockdowns in Europe and tensions with China also weighed on investors' mood. The EU, the US and Canada imposed sanctions on Chinese officials for human rights abuses in Xinjiang. On the data front, the unemployment rate unexpectedly fell to 5% in the 3 months to January. The CAC 40 ended 19 points, or 0.3% lower at 5950 in choppy trade Tuesday amid mounting concerns over rising coronavirus infections and further lockdowns in Europe, while the pace of vaccination remains slow. Germany extended the lockdown until April 18 and ECB chief economist Philip Lane said the region is facing a difficult second quarter. On the corporate front, shares of Valeo and Renault were among the worst performers. The BSE Sensex index climbed 280 points, or 0.6% to 50,051 on Tuesday, boosted by gains in bank shares after the Supreme Court rejected requests to waive off interest on loans under moratorium. Also, sentiment improved after U.S. Treasury yields retreated and news that AstraZeneca's COVID-19 vaccine performed better than expected in a major U.S. trial. On the policy front, India's market regulator on Monday relaxed new valuation norms that were set to affect certain bonds worth more than $12 billion after the government flagged concerns of disruption in debt markets. The FTSE MIB traded lower on Tuesday, in line with its European peers, amid concerns over a new coronavirus wave in the continent, which could delay plans to ease restrictions. On the vaccination front, the Italian government promised 4.5 million doses until Easter. However, officials worry over the lack of logistical means of some regions to handle the surge in the number of jabs. On the corporate side, the Italian securities market regulator approved the bid from Crédit Agricole Italia for the total shares of Creval at €10.50 per share. The Shanghai Composite lost 31.93 points, or 0.93% to 3,411.51 on Tuesday as Western sanctions against China and lingering worries over policy tightening weighed on the market. The US and others including the EU on Monday imposed sanctions on China over Xinjiang's abuse, while Beijing hit back with punitive measures against Europe. On the pandemic front, China reported 9 new COVID-19 cases, up from 7 a day earlier. In local news, the Chinese government issued draft guidelines to regulate the e-cigarette industry, dealing a major blow to the world's biggest market for tobacco products, while Reuters said that Chinese internet giant Tencent Holdings is offering concessions in a plan to merge the country's top 2 video game live streaming sites in order to resolve antitrust concerns. Meantime, the Hang Seng Index fell 390.11 points, or 1.35% to 7-week lows of 28,495.23. The Japanese yen added 0.107 points, or 0.1% to 108.731 against the US dollar on Tuesday, trading off 9-month lows following the BOJ's move Friday to allow long-term interest rates to fluctuate in a wider band. The bank removed a 6 trillion yen, $55 billion, annual target for buying exchange-traded funds while maintaining a ceiling of 12 trillion yen in a move designed to allow yields to fluctuate more. Local 10-year bond yields eased to 6-week lows of to 0.079%, while U.S. 10-year rates retreated further from 14-month highs to 1.665%. Meantime, local media reports said Japan will use 2.17 trillion Japanese yen in reserve funds for fiscal 2020 to financially support businesses and households suffering from the prolonged impact of the COVID-19 pandemic. Thank you and please stay tuned for more upcoming reports. Institutional investors, be sure to visit my website to subscribe and ask for a free copy of the Bull Valley Advisor Stock Market Newsletter. www.bullvalleyadvisors.com. You can also subscribe and listen to my podcasts on Anchor at anchor.fm/Len-Martinez-PhD-CPA. You can also subscribe and listen to my podcasts on Google Podcasts, Apple Podcasts, Breaker, Radio Public and Spotify. Len Martinez is a financial consultant. Information in the Bull Valley Advisor newsletter should not be considered as investment advice or an offer to buy or sell securities. Data is derived from sources considered to be reliable, including Morningstar, StockCharts.com, Yahoo Finance, Finviz, TipRanks, Investing.com, ECRI, OECD, Guru Focus, Crestmont Research, Trading Economics, and S2O. Results are not guaranteed. Len Martinez is not an RIA. The data is shown for informational purposes and should not be considered investment advice or an offer to buy or sell securities.
With our market recap, as I mentioned, distribution day for sure. The S&P down about 0.75%, 39.10 is about the close of the day. Most of that sell-off came after around 1 to 2 p.m. As you saw some distribution here. The NASDAQ a little further now, but mid caps and then small caps are really the story. The small cap index, the S&P 600, down about 3.5% today. It's quite a move. And again, this is not the first day that that's happened. We've seen a trend in small caps here. This is the IWM, the Russell 2000 ETF, a little different, but same idea. This sell-off that you've seen today, this is today's bar there in green. This is after about a week and a half of overall distribution. We've had some bounces along the way there, but you've really seen the Russell 2000 come off of all-time highs there about a week and a half ago, and then really distributing. What's encouraging about this chart is that it's not making new lows yet. Even with the distribution on a day like today, which feels severe, you're not even below the lows from early March, right? You're still remaining in an overall positive trend. I think this sort of distribution is going to shake a lot of people out, at least mentally, from what's been going on here. The question is that sort of move sustainable? I think there's a corrective pattern that we're in. I think we'll see more weakness from different ETFs and different indexes, but overall, the market should resolve this whole experience to the upside. The question is how long that's going to take and how much pain we need to feel first. The VIX, by the way, back up above 20. 10-year yields back below 1.7%. That happened yesterday, continuing lower today with the TLT, which we usually use for bond prices, up almost 1%, and the dollar index continuing higher. Gold continuing weaker, silver down almost 3% or just over 3% today, which is a pretty big move. Energy also struggling as oil prices came off pretty well. USO down almost 6% today. So a rotation away from commodities, a rotation away from most things today. Very few things up. The dollar, one of those that comes to mind. Cryptocurrencies, by the way, up as well, with Bitcoin up not a ton by crypto standards, up 1.5%, but overall most of these top 10 most liquid ETFs, coins that we follow in the green today. Let's focus on a chart of the S&P 500. I did an interview this morning and was asked about just the overall trend. And again, what encourages me about this chart is the fact that we keep making higher highs and we keep making higher lows overall, right? So if you look from 2021, the beginning, the first 3 months here, we're almost done with the first quarter, we've seen a successive pattern of higher highs. If you look at the January, February, March highs, every month we have made a new all-time high. That's impressive. Every month we have also managed to make a new higher low, right? So here in the end of January, you pulled back to around 3,700. We didn't even make it down to there in early March. That's all positive. What concerns me on this chart, the reason why I'm not ecstatically telling you that the market's going to rip higher from here, is this line at the bottom, the RSI. If you look at the momentum on stocks, every time the S&P has moved to higher highs, the momentum has made lower peaks. So higher prices on weaker momentum is not the sign of a healthy bull market. It's the sign of a market at an exhaustion point or nearing an exhaustion point, a market where momentum is coming out of it. Now, it's not just on that chart that you're seeing that sort of divergence, right? If you look at the semiconductor index, SMH, this is a chart we highlighted many times in the last month, but this higher high in price, lower peaks in RSI, this is the signal for us that the technology growth trade was waning, that the market was going to a new high on weaker momentum that was not sustainable. Since then, semiconductors have undercut their January low. While the S&P has remained above, semiconductors, a lot of tech names actually undercut it. I would argue there's still more pain to be had with semiconductors before all is said and done. If you look at a chart like JP Morgan, arguably right now, you're getting a similar sort of pattern. This looks like semiconductors a month ago, where you had higher highs in price, you have lower peaks in momentum. So some of these high-flying groups recently, like financials, even some energy stocks, you're getting these bearish divergences, which signal or indicate likely trend exhaustion. So, while that does not necessarily mean the market experiences another, January, February of 2020, it's not necessarily saying we're going to have another huge major top, although it's worth noting that December, January, February in semiconductors looked a lot like January, February of 2021. A lot of similarities between those two patterns for sure. So again, it could happen, absolutely. For me, what would tell me that happens is if you have stocks breaking down, not just not going up anymore, which is where a lot of names are. It's whether they start breaking support. What concerns me, which makes me not super optimistic about stocks in the near term, is the fact that semiconductors have already broken down through their January low. And what that means for me is I see this bounce that we've seen as a bounce before the next move lower, and not just the bottom that is now resolving back to the upside. I don't see downside exhaustion signals yet on the semiconductor chart. I could be completely proven wrong if we continue to appreciate and stocks start to work. But I am more surprised by days like yesterday when semiconductors do so well, or the day before, and less surprised by a day like today when semiconductors are coming off 2.5%, because I think that makes sense for the overall structure that we're seeing in stocks. That was a bit of a rant on overall market dynamics, but I hope that made sense for everyone. Looking very quickly here at the other themes before we take a break. In terms of sector leadership, very defensive on the top here. You have utilities, number one, consumer staples. And it's funny when you look at a chart of like General Mills, GIS, it's actually not a bad chart, which is kind of funny to think, because this is a stock I don't think of as leadership and I don't think of as outperforming. But if you look at the month of March, it's done both of those things. It's accelerated out of a pretty depressed level. The relative strength has been positive through the course of the month, just recently overbought. So this pullback that you see makes a ton of sense because it was overbought, because it met previous resistance there from November, even back in October, and also that same level in January. So kind of at that point, the upper end of this range. If that changes, if we get above 62 and illustrate some follow through after a brief pullback, I'd be much more of a believer in a name like this. However, what I'm seeing is more of a defensive name that hasn't really done much, especially on a relative basis over the long term, at the upper end of a range. It doesn't get me super excited, but making a higher low on a pullback, breaking above 62, sort of following through to the upside, signaling that this wasn't just a fluke, but more of a longer term trend that's beginning, that would be of interest to me. I think not Goldman Sachs, GIS, General Mills, has a little more to prove before I believe on much further upside from here. That's our market recap for today. We need to take a quick commercial.